Welcome to By the Books, the podcast helping business owners navigate the complex world of business, tax, and bookkeeping. Now, to the owner and president of Kline, Lindsay Kline.
Thank you for joining us, everyone. This is Lindsay Kline with Kline, honest, accurate bookkeeping performed on time. I'm here today with Josh Dixon, who is a CPA and an owner of J. Dixon Tax here in Frisco, Texas. He's also a member of the Wealthability Network, which I found out is part of this Rich Dad, Poor Dad network that I didn't even know existed. So this is pretty cool. I'm going to have to check this out.
Yeah, that's correct. It's fairly new. Been at it for a couple of years now. This is kind of the dream of Tom Wheelwright. He's the founder of the Wealthability Network. He's also the author of Tax-Free Wealth. And he is Robert Kiyosaki's CPA.
Which I had no idea. So I seriously am going to have to check this out because I have followed Robert Kiyosaki's books for years. So
and a lot of people are very familiar with Robert. Robert definitely has more kind of notoriety or more popularity. People, recognize the name more.
But I'm very curious about the CPA that he would pick to do his personal stuff.
Of course, yeah. I mean,
this is interesting.
Robert's made a couple of mentions of him. Tom actually kind of acquired Robert. So Tom, years and years ago, before he met Robert, was purchasing a CPA firm and ended up purchasing a firm that came with Robert Kiyosaki.
Oh, interesting.
Yeah.
So Robert didn't actually pick him. He just kind of fell into him.
Yeah, it was kind of more by accident.
That's really interesting.
And so it worked out that Tom happened to be this really great CPA, and he met Robert. And interestingly enough, one of the things that they found out about when Tom first took Robert on as a client was that Robert had all this real estate and all these properties, and he'd never done a cost segregation study, which, if you're not familiar with cost segregation, it's a type of depreciation.
Okay, which is our topic today.
That's correct.
We're talking about depreciation, which is such a confusing topic.
It can be, but it doesn't have to be.
But it is for the regular person, and even I'm in that world, right? I'm an accountant. I'm not a CPA, but I'm an accountant.
Okay.
It is still massively confusing.
Really?
And especially when you add the dynamic that there's tax depreciation methods, right, that the IRS accepts.
Sure.
And then there's GAAP depreciation methods, right, the generally accepted accounting practices, which are not necessarily the same as what the IRS accepts.
True.
So there are, it seems to me, basically endless different ways to depreciate your fixed assets.
Well, okay. To be fair, yes. So,
I literally had a accounting professor tell the class, I just ask my clients what they want their profitability to be for the year, and I give it to them. And he does it through depreciation.
Yeah, I mean, I guess you can do that way. That does kind of work to a degree, right? So, what you're talking about is, book depreciation is a lot different than tax depreciation. Tax depreciation is what everybody thinks about, if they even think about it at all.
Well, yeah.
But tax depreciation is the more interesting part.
Let's define depreciation before we get into the nuts and bolts.
Right.
What is depreciation?
Well, why don't you give me your definition first?
Okay, so I would say it is taking the cost of an expensive asset, whether it be a building, a car, a piece of equipment. Usually the threshold seems to be about $2,500. That's what most CPAs tell us. So things that are above $2,500 or more, it's taking the cost of those items and expensing them out over a period of time, usually several years.
Right. Okay. Yeah, that is a very good definition.
Okay, good. All right.
So,
Step one.
What if I said, what if I have my own definition, a different definition than yours?
I'm sure you do.
What if I said the depreciation is free money from the government?
Free money from the government.
Yeah.
I'm very interested to see.
Have you thought about it that way?
Free money from the government. I'm trying to think of how that translates to free money from the government.
Yeah.
Is it because of the aspect that you can kind of manipulate when you take your deductions?
There is some of that.
Okay.
Sure.
So
You
What
know,
do
and
you
I
mean?
mean, and the government changes this stuff all the time. So, years ago we had just kind of, straight line depreciation, and then we added modified accelerated cost, blah, blah, blah. And then we added bonus and section 179 and all this different stuff, right?
So how many different ways will the IRS accept depreciation? Like, how many methods are there per the IRS?
Well, I mean, there are a lot of different methods, but really it's just kind of, most people go with what's most advantageous, which is to take the most upfront that you can, right? And so right now that's bonus depreciation. A lot of times they'll let you take 100% on, a lot of different equipment and things that are under 15 years depreciable life is what they call it. But
so if you can depreciate it in less than 15 years, then you can take that bonus depreciation.
Yeah, and you basically get to take it all up front. Now, you can, elect out of it and all these different things if you really want to. But really for tax purposes and what's most beneficial for people, of course, is to take as much upfront as possible.
But not always, right? Because there may be a bad year for a company where it's not that advantageous to take another deduction because they're not going to be paying taxes anyway, right?
Well, I mean, yes and no, right? So if you take the bonus depreciation, if you can't use it for whatever reason, then you just can carry it forward.
Gotcha. Okay.
Whereas if you say you elect out of it, then you can't really go back and say, oh, well, now I want to elect in.
Okay.
Now I want to take it.
How many years can you take that forward?
Should be. I think it should be 20.
20 years. Okay.
Yeah.
So you can take it forward for quite a while. And if you're not profitable in 20 years, you've got bigger problems.
You got a big problem. That's right. Absolutely.
Okay.
So,
gotcha. So there's really not many cases where you would not want to take that bonus then.
No, you pretty much always want to take it as soon as you can.
Okay.
So the depreciation is basically decided by the government. They get to decide how quickly you get to take, deduction on something.
And specifically
or
the
how long.
IRS, right?
Right.
Okay.
Correct.
Gotcha.
Now, I mean, a lot of this stuff is decided by Congress. Congress writes these laws and the IRS helps to implement them.
Gotcha. Okay.
But the idea is you want to try and take as much depreciation as quickly as possible. And a lot of times you'll see, the government's been kind of accelerating depreciation over the years. They've tried to make it easier and easier to take it sooner. And a lot of that is because a lot of it is beneficial for the economy. Mm. People, it encourages investment into different projects, encourages people to buy equipment, things like that. They want, the people to engage in these activities. And that's why they offer this benefit. That's why they offer essentially, free money from the government, right?
Okay. I still can't wrap around the free money thing because, I mean, if the government is lessening the time that you can write these things off, ultimately all you're doing is taking your deduction sooner, right?
Correct.
So it's not really free money from the government. It's
could
just
be.
getting a deduction sooner.
It could be. Do you want me to show you how?
Okay.
Okay.
All right. I'm interested to see how this turns into free money from the government.
All right, let's talk about it. So, depreciation, or, what Tom would call the magic of depreciation, right?
Okay.
Is that you essentially get a deduction for something that you didn't necessarily pay for.
Now, why do you say not necessarily? Because you might have financed it?
Correct. Yeah.
Okay.
So like in the
Gotcha.
case of real estate, you may have borrowed money from the bank to purchase that real estate.
Okay.
Maybe you put 20% down, but you got an 80% loan from the government. Or
Gotcha.
not from the government, I'm sorry, from the bank, right? But the government lets you take a deduction on 100% of what you bought.
Okay, so what you're saying is because you can take a bigger tax deduction, reduce your tax liability more than what you paid that year for that asset.
Correct.
Okay.
Yeah. And so, essentially you get to lower your tax bill, which basically puts more money in your pocket because that's money you didn't have to pay to Uncle Sam.
Gotcha. So it's kind of like an interest-free loan in a sense.
Yeah.
Okay.
The way we look at it is, the government wants to partner with you on certain activities. If you engage in the activities that the government wants you to engage in, they're going to give you benefits.
Nice. Okay.
So depreciation is one of those things.
So what does the average business owner need to know about depreciation? What is important for them to know as they're making these purchases?
So, I mean, the biggest thing is, how quickly can you take the deduction, right? You want to know, can you take it all up front? Do you have to, spread it out over
so
time.
you mentioned 15-year threshold earlier. How would the average business owner know whether something is depreciated more or less than 15 years?
They probably wouldn't. So that's where it would be helpful to have, somebody who's knowledgeable in depreciation to be able to help you determine, what that is.
I'm assuming buildings would always be more than 15 years. Is that correct?
For the most part, yes.
Okay.
So, like if you bought a rental house, that's typically going to be 27 and a half. If you bought a commercial property, it's going to be 39 years. But where it gets more interesting is if you engaged in a cost segregation study, there are ways where you can take some of the contents inside those buildings and depreciate those quicker. So like if you bought a rental house, let's say, and the house itself is going to be 27 and a half years, right? And anything that's kind of structural to it. But if you also bought, the cabinets inside the house, the carpet inside the house, the appliances inside the house, all these things can be depreciated much more quickly.
Interesting. So you can take part of the cost of the house out of that 27 and depreciate it faster.
Correct.
How does that work? Do people need to, I assume, track these expenses for upgrades? And
right. So, so a lot of times people will try and do it themselves.
Okay.
That's an option. There's some DIY software out there if you want to try and do your own cost segregation study. We typically recommend getting an engineer involved or a CPA involved that can help you with figuring out, the depreciable life on these different items.
Which would probably be worth it for somebody that's in the real estate industry and they're doing this often.
Absolutely.
Okay.
So, and that was one of the things that when Tom met Robert, right? Robert had never done a cost segregation study. And Tom was like, man, I can't believe this. You're sitting on like millions of dollars worth of deductions.
Wow. That's
and,
amazing.
And so, because of that, then now Robert's a client for life.
Wow.
Right?
That's really neat, actually. Okay. So that's good for real estate. What about if it's not something that's real estate related? Let's say it's a piece of equipment.
Sure.
That's specific to an industry. What then would determine how long you can depreciate it?
I mean, it depends on the type of equipment, but, most equipment's going to be under 15 years.
Okay.
So you'll get 100% deduction right away. A lot of people, they go to a CPA or a tax preparer, and they'll bring them all the information from the year that they've done. They'll say, okay, well, here's what I bought throughout the year. And a lot of times, because we have this 100% bonus depreciation, accountants and tax preparers, CPAs, they'll just go ahead and do it on the tax return. And you may not even know it happened. So, like you were talking about the $2,500 threshold. Mm-hmm. Some use $1,000, some use $5,000. Yeah. It just kind of depends on what kind of industry you're in, or even really what CPA or accountant you're using.
Exactly.
It's kind of their preference and what they feel comfortable with. But but that threshold, I mean, is kind of where they determine what to put on the return as depreciation or not. And they kind of do it behind the scenes, and it shows up as a deduction on your return. So you probably don't even really know that it's happening most of the time.
Which it's something that typically shows up at the bottom of an income statement, right? And a lot of times people disregard it, right? They're looking at, what is it, EBITDA? That number that's before the depreciation. So it almost seems like, I feel, to the public at large, that it's something that you just don't even pay attention to, really.
Right, but really, like I said, they should. Because that can be a very powerful deduction. That can be a very big, cash flow item. I mean, if you don't have to pay the taxes on that purchase or that depreciation, that's basically essentially money in your pocket, and that's where that free money from the government comes in, because that's money you didn't have to send to the IRS.
Right. So let's say that there's a business owner listening to this that's maybe not even sure what depreciation method has been used for the equipment or whatever they bought. What would you suggest that conversation look like if they were to go ask their CPA about this? What should they be asking?
Yeah, so I mean, they should definitely ask, are we taking depreciation? Let's just start there.
Okay.
Right? Because believe it or not, a lot of people will go out and they'll buy like rental houses, and for whatever reason, they didn't think to ask, the CPA didn't think to put it on there, or the tax preparer, and they don't take depreciation at all.
Oh, wow.
For several years.
Well, and that's key too, as a side note, especially from a bookkeeping standpoint here. There is a lot of times when business owners will go purchase a large item and may not tell anyone.
Mhm.
And, I know this is shocking, but we are not mind readers. And sometimes it's obvious. I mean, we actually have a monthly checklist item, which is to look specifically for anything over 2,500 so that we can spot anything that might be a fixed asset and we can ask about it. But let's say, and this does happen, the owner were to go purchase it with a personal checking credit card that we don't see, which big no, don't do that. But let's just say that were to happen and it has, then how are we ever going to know? Because it's not even an account we monitor.
Right. You just won't.
Or maybe they go get a loan that's a personal loan that's paid outside of some account we see. Again, how are we going to know? Or maybe they pay the payment with a personal account or a business account, but maybe we don't realize that it's a loan payment. If it's made out to, we usually question this stuff, but it could fly under the radar if it's a $500 payment.
Yeah.
Now, if we see that it is to a bank or some kind of lender, we try to question those things.
Sure.
But yes, these things do happen to slip through the cracks sometimes
A lot of
because
times.
the business owner doesn't realize this is a super important thing to let your accounting professionals know.
Yeah, I mean, you're missing out on a lot of deductions. You're missing out a lot of, you're essentially paying more in taxes than you'd have to otherwise.
Right. Yes.
And I don't know who really wants to do that.
So how do you fix that kind of mess? Because I have seen this happen where I had a new client, in fact, that as I was walking through her tax returns, just trying to see what the situation was, she's telling me about a vehicle that's a company vehicle, and I'm not finding it on any of her tax returns. And she was shocked. She's like, well, it's a company vehicle. It's in the company name.
Right.
What do you do in those instances where somebody's had this asset for multiple years now and it's never shown up on any tax return? How do you fix that?
I mean, there's always a way to fix everything. That's the way I look at it.
Do you amend those tax returns or?
Not usually.
No?
I mean,
How do you fix
that would
it?
be an option if you wanted to do that, but this is a little more advanced. But there is a form. It's a 3115 form. And it's called an application for change in accounting method.
Okay.
So in that case, there's two boxes. There's a box you can check if you're going from a correct method to another one, like cash to accrual. But there's another box you can check where it says if you're going from an incorrect method to a correct method.
Interesting.
You can catch up on your depreciation. That way.
In those instances, would the IRS actually send a refund for those missed deductions?
I mean, if you did end up doing like an amended return or a carryback, they would. If you do a change in method and you just report all the depreciation that year, any unused depreciation or unused deduction would just carry forward.
Gotcha. Okay.
But that's where kind of tax planning comes in, something that we do, and that is, maybe it makes more sense to take that. If we have an item like that, if we can take a lot of depreciation in 1 year, maybe it makes more sense to do it in a high income year.
That does make sense. Okay.
So you can get the most, tax benefit for it.
So I would say it would be a good idea for any business owner to go in with a list when they're talking to their CPA. Here is all the assets that we have. I want to make sure that we're actually depreciating all of these.
Yeah, absolutely. I think it makes sense to go through and make sure that your depreciation schedule, you should have one. A lot of times, for whatever reason, it seems like people don't get a copy of it. Their CPA or tax preparer doesn't give it to them. But, if you don't get it, make sure you ask for it and make sure that it's correct. Right. Make sure you have all the old items off there. I mean, I'm sure you've probably seen it, right?
I have seen where, yes, a CPA will send and I'll review it and I'll see things on their depreciation schedule that they haven't owned for years. And it was even things that we emailed the CPA to say this was sold on this date for this amount, and still they left it on there. So yes, you have to check those.
I have clients that they keep their 1999 fax machine still on there. It's like, wow. Do you still really using that? Are you? Does that thing still run?
So how much of a problem is it if you're still depreciating an item that you sold years ago?
Well, I mean, you definitely don't want to do that, obviously. If you don't own it anymore, if you've sold it, if it's
so let's say that's happened because I've seen it happen.
you shouldn't be depreciating anymore, but
Right.
you know.
Right. But let's say, because we have seen it, I'm sure we've both seen it, where
Mm-hmm.
somebody's depreciating an asset that they sold 2 years ago.
Yeah, no,
How do
I
you
mean
fix
that
that
can
issue?
definitely happen. You know, same kind of method. You can do an amended return, or you can do a 3115 form. The 3115 form is a little bit of a nuisance. You know, so it's not something that I wouldn't recommend somebody attempt it on their own.
Can you
without-
basically just act like you sold it in the current year? Or is that a no-no?
No, I don't think I'd recommend that.
Okay.
Yeah, I'd really prefer to
Come clean on
report
it.
things as they happen in the year that they happen.
Well, obviously, that's
So-
ideal. Yes.
So yeah, we'd probably go back. I mean, if it's depending on what it is, we might go back and amend.
Okay. So, what do you typically recommend for the average person? What's your go-to method?
Well, I mean, like I said, we always want to try and do things as quickly as possible.
So the bonus depreciation,
the
that's like
100%,
your favorite.
100% bonus depreciation. Take as much of that as you can right up front.
And then just roll over any losses that you have to the next
any
year.
unused you can carry forward. I mean, most people have some kind of an income that they can offset it with. So it's usually beneficial immediately.
Okay, that's good to know.
There is 100% depreciation or 100% bonus, whatever you want to call it, on certain vehicles. There's, if you use your vehicle primarily for business, then if your vehicle weighs over 6,000 pounds, then you can depreciate 100% of it, in the year that you buy it.
Wow. Okay.
So you can get a pretty hefty deduction that way.
So I did a podcast episode a while back called "The Answer That Every CPA Answers Differently." And it was about a situation where a guy kind of got into a sticky situation because he took bonus depreciation and then he switched to be taxed as an S corp. So he was taxed as a sole proprietor, as an LLC, and then he elected to be taxed as an S corp. And in the prior year, he had taken a bunch of bonus depreciation, which caused a sticky situation. So could there be instances where if someone's thinking about changing their tax status, being taxed from a sole proprietor to an S corp or something similar to that, should those factors weigh into the decision on whether or not to take that bonus depreciation? Like if someone's about to change their tax status next year, would you recommend something otherwise?
Well, I mean, it would probably make more sense to wait, I guess, until you have the S in place.
Okay.
But, setting up an S corp, that can be done, basically at any time.
I think in this situation, I'm trying to remember I think it was a basis issue because they had financed it, but in an S corp, if I'm understanding correctly, you have no basis for the financing.
Right.
And so he had this bonus depreciation creating this huge liability issue on the balance sheet. So a negative equity situation. So that's where it just kind of created this weird situation. And I went to a CPA group where everyone's discussing this and it really stumped this whole room of CPAs. Like, So there was a lot of different recommended solutions. This is how I created this episode about the question that every CPA answers differently, because I probably asked 10 or 12 CPAs after that how they would fix this issue, and every single one of them gave me a different answer.
Right. Yeah, I mean it's an unusual situation.
It
Let's put
is.
it that way. So I mean it wouldn't apply to a lot of people.
So that I would just guess based on that particular situation that if you're thinking about changing your tax status in terms of your type of entity,
right,
that needs to factor into your depreciation decision.
Yeah, so I mean, and also it kind of depends on, like you said, financing can be an issue. Banks and people that you're getting a loan from might have different requirements, so you may not be able to get certain types of financing inside of like an S corporation. Especially if you haven't been established long.
Right.
So you may have to buy it personally anyway.
That makes sense.
And then essentially like contribute it to the business.
Right.
But
there's a little bit more, I guess, loops you have to go through in that situation.
Right. Yeah. No, it is more complicated. Our usual recommendation actually is that you would buy the vehicle personally. And then, if you have like an S corporation, that you would just reimburse yourself
for the mileage
from the S corporation. Yeah.
Gotcha.
For the mileage or repairs. It's kind of an either or situation.
Gotcha.
But there's like standard, mileage deduction, or there's the,
So in
actual
that
repair
case,
costs.
then you wouldn't be depreciating the asset because it's a personal asset. Is that right?
That's a great question.
I stumped the CPA.
I think that's your goal every time, isn't it?
I do my best. So you for sure can take the mileage, or
You know what? I think you can still do it. You can take a depreciation.
you can depreciate an asset that doesn't belong to the business.
You could. So
Really?
basically, probably what I would do is lease the vehicle to the corporation then.
Interesting. Okay.
And then, and then essentially you can depreciate the vehicle, and you're just going to charge a lease fee.
Interesting. Okay.
And then there could be a adjustment in there for mileage or however you want to do it. But yeah.
Okay.
So you could essentially lease the vehicle to the business that way.
Now, if you're reimbursing yourself as a business owner for mileage, can you still take a mileage deduction on your tax return?
Not on your personal, just on the business. But if you're in like a partnership or an S corp or something like that, it's going to flow to your personal anyway.
Okay. So,
Right? So you're going to get the benefit either way.
but if you personally paid yourself for the mileage,
Mm-hmm.
you can still write off in the business that mileage, even though you.
Well, that's what that's what happens. So yeah, so when you reimburse yourself, like from the S corporation to your personal,
You're just writing off that expense that you've
that
reimbursed
particular
yourself.
expense,
Right.
yeah,
Okay.
the mileage or whatever.
So you're not putting in your mileage deduction on your return in addition to that. Gotcha.
right.
Okay, that's it. Okay,
Yeah.
that makes sense.
No double dipping.
Yeah, no, that makes sense. Okay. Anything else that you feel is important that business owners know about this?
So, something else that's come up recently, so I'm part of Tom Wheelwright's Wealthability Network. And at the Wealthability Network, we believe that the the tax code is a series of incentives that the government gives us to engage in certain activities, right? And so one of the things that they're working on right now is there's some pending legislation. Most people probably don't keep up with the stuff, but, Congress is always busy at work. They got to do something,
Of
right?
course. Yes.
And they got to keep themselves busy and try and justify their paychecks.
I don't know if you saw the episode with Robert Gralla, but he brought in a tax book that was probably 4 or 5 inches thick. And he was telling us that like 20 years ago, it was only like a half an inch thick. So that's how much it's grown just in the last 20 years.
Oh, I know. Yeah, for sure. And
makes you wonder how thick that book will be in 20 years from now.
I think these guys get paid by the pound.
Right?
It's ridiculous. I mean, it's just crazy the stuff they come up with. But we believe it's a series of incentives, and that the government gives you incentives to do the things that they want you to do.
Of course.
Right?
Yes.
And so that's why they have depreciation, right? We talked about this a little bit in the beginning. With depreciation, they're trying to encourage investment, right? They want people to buy houses or build houses. They want people to buy buildings or build buildings. They want people to buy equipment and lease it out, or whatever it may be. They want to encourage that. They want people to buy cars, right? So they make the 100% depreciation or deduction available for cars. And so one of the things that's coming up, or at least that we see coming, is that with the new administration, we think there's going to be a large push towards green initiatives, right? And so, because that's been kind of a hot button issue for them for a while now. And so I think there's going to be a push for incentives for green energy development, whether it be solar, wind, hydro, whatever the case may be. And one of those things that they're talking about doing is reinstating the 30% credit for solar panels. And so, it's hugely beneficial for people if they want to put solar on their houses or whatever. But even more importantly, and even more beneficial, right, is if people want to put solar panels like on their business, or if they want to put solar panels on their rental properties or something like that, because you can also depreciate the solar panels.
Oh, gotcha.
Solar panels are less than 15 years. So you get 100% deduction, the first year when you install them. Now, you do have to offset that a little bit. It gets a little more technical. You have to reduce the depreciation deduction by I think it's by 50% of the credit. So,
okay, I was going to ask. So you do have to take that credit into account when you are
right. So there's a little bit of an adjustment there. So you really kind of get 85% instead of 100, but then you also get the added benefit of the 30% credit. So these two
But that's
combined,
not in effect now. It's just they're talking
about it.
Okay.
Yeah. So it looks
may
like
be in the works.
Yeah. So don't rush out and do it before Christmas. But don't go buying solar panels for Christmas.
Okay.
But
So this is in the talks maybe for 2022?
probably.
Okay.
Yeah. I mean, I suspect they're probably going to pass it before the end of the year, but it's probably going to be like, that's how they're going to celebrate New Year's for them, right?
Well, and they love now. It's the new thing to change things in the middle of tax season.
Yeah,
so you
that was a
never
big
know.
surprise this year. We love getting new tax laws and bills and things in the middle of tax season, like in March this year.
For the prior year. That's
Right. I mean,
crazy.
it was ridiculous. So, I mean, that was, if you have a CPA or a tax preparer, please forgive them.
Right.
It's been a challenging year.
Yes.
For sure. We've had a lot of, the new laws come out and then, we have to wait on the IRS to tell us, how does it work?
Right.
and then we have to wait for our software companies to update it.
Right.
So that we can actually put it into the software and make it work. And so.
And I'm just imagining, I know from the bookkeeping side of things, it's always a win when you get a set of books caught up and it's like, all right, we got this in maintenance level now.
Right.
We've got this huge cleanup project. But for you guys, it's like getting those returns done. So I can't even imagine getting all these returns done just to find out everything's now changed and we're going to have to go redo those.
Right. Yeah, no, exactly. Now, I mean, the IRS is very nice sometimes. Not often, but on rare occasions, right? And they actually fix stuff for us, which is nice.
Oh, good.
And so one of those things was like this year we had the unemployment. A lot of people had unemployment in 2020, right? Makes sense. Everybody was laid off, right? Essentially, or furloughed, or whatever you want to call it. A lot of people got unemployment. Well, in 9 states, community property states, Texas being one of them, you were allowed to essentially double dip on the exclusion. So that was one of those things they came out with like mid-March. They were like, hey, you can exclude, $10,200 of your unemployment. And then later on, they decided, oh, wait, you can actually do that in community property states. You should actually do that twice. And so they ended up, that's one of the things that the IRS kind of fixed for us if we didn't fix it ourselves. They went ahead and just issued additional refunds to people that this applied to. And I think it was yesterday or today they announced that they're sending out adjustments to 450,000 more people.
Wow.
That, didn't take advantage of that additional deduction. They just went ahead and fixed it for people. And they're going to send them some surprise refunds.
Well,
so hopefully
good that you didn't have to do amended.
Hopefully that's in the mail. Yeah.
Right.
Hopefully it's on its way. But but yeah, no, we're expecting some new laws, some new legislation. Probably by the end of the year. I know there's been a lot of kind of back and forth this year, and they, can't seem to get together on the same page about it. But I'm pretty sure it's going to happen, but probably like December 30th.
Yeah, exactly.
At midnight. Whatever the last minute is that they can do it. And one of those things is probably going to be the solar panels that we talked about. And if you do that combination of the bonus depreciation, which is not available personally, right, like we talked about, but it is available to business owners, rental property owners, that sort of thing. If you do the combination deduction and credit, it effectively covers like 67% of the cost of doing solar panels, and you get the added benefit of reduced electricity costs. So,
okay, so if they could just fix how they look, because they're hideous.
Totally agree.
I just can't get into the look.
I know.
If there was a way to hide them somehow or make them look like regular shingles, that's what they need to work on.
True, for sure.
Yeah. So they got some ways to go on that, I think, before they're going to be very widely accepted.
That's true. Yeah, I don't think my wife's gonna let me put any on my house.
I understand. I get it. So here's the question that I'm getting asked now, and I'm sure you are too. How do you get a hold of the IRS now?
You don't.
Yeah, it just seems like that's the issue.
You don't. So, it has gotten a little bit better now that we're kind of past the
have you found there's better times
deadline.
and days? Like, I had a business owner ask me this the other day, and I said, well, try Friday at the end of day, like right before they close.
Sadly, yes.
Is that when you've had success getting a hold of them?
That's usually when I get through. Yeah. So, a lot of people, they like to spend their Friday nights going to dinners, watching movies, spending time with the kids. My Friday nights are talking to the IRS.
And probably true for a lot of CPAs.
Yeah, it could be. I hope not, but it may be true because that's just the state of things right now. Yeah, I mean the IRS has been very backed up this year.
Yes,
they're only answering, depends on who you talk to. Officially, I think they're saying 20% of their calls, but it's really more like 5 or 2. They're really just not answering a majority of their calls.
And I've heard they have just tens of thousands of pieces of mail unopened.
Yeah, so I think that's still going on. I mean, at one point it got up to like 13 million or something that they were working on. And
wow.
At least, especially during the pandemic last year, they were having like semi trucks just parked in the parking lot and they were just throwing the mail in there. Like, we'll get to it when we get to it.
It's unreal. So yeah, for a business owner that's trying to get a hold of them for, an important issue, in this case, the business owner was having difficulty because of some how should I say it? Some 941 returns that were done improperly.
Sure.
And he's trying to rectify the issue, So, this is a stressful situation for a business owner that, they know they need to get a hold of the IRS to resolve an issue. I don't even know what advice to give them other than Friday night. That's your night.
Yeah, give it a shot. If you have the benefit of having a California number, that can help you out. Because the hours of operation, depending on who you're calling, are either 7 to 7 or 8 to 8, based on your time zone. So
gotcha.
A lot of times, like I have a Colorado number because that's where I'm from originally. And so if I have to, I'll call on my Colorado number because that at least buys me an extra hour.
That's smart.
In the evenings,
this is good tips. And I think there's apps where you can get phone numbers from other places.
Yeah,
Would that work?
Yeah, you could definitely. I used to do that. I had a Magic Jack for a little while. You can buy one for like $20 at Best Buy. Just get a California number.
Get a California number and call it the end of day Friday.
Because that'll buy you an extra couple of hours.
There you go.
It's really kind of gives you, if their hours are 7 to 7, it really kind of gives you till 9 here in Texas.
Okay.
So.
That's good to know. We're getting the tips and the tricks on
it
getting
does,
hold
it
of
does
the
help
IRS.
a little bit, but I will say, I mean, the lines are what they are. They're busy.
Mm-hmm. All right. Well, this has been good. Very informational. Thank you for joining me on this today.
Thank you for having me.
How can people get a hold of you if they would like to learn more about you or possibly use your services?
Yeah, no. So I have my website, of course, J Dixon. That's JDixon CPA.com. And of course, you can also Google me, J Dixon Tax in Frisco. And then a phone number?
Sure.
Okay.
Yeah.
214-390-9711.
Obviously not his Colorado number.
No. No, that would be the official company line.
Gotcha. And I am Lindsay Kline. You can reach me at info@sakline.com, SAKLINE.com. And of course, our website, sakline.com. And all of our links to Spotify, Google, Apple, anywhere that you can find our podcast is on our website. Thank you so much for joining us today. This is Lindsay Kline with Sakline, honest, accurate bookkeeping performed on time. Until next week, have a great week, everyone.
By the Books is presented by Kline. Honest, accurate bookkeeping performed on time. For more information on Sakline services or to get a hold of Lindsay, visit sakline.com or email info@sakline.com.
The information provided on this website and podcast does not and is not intended to constitute legal advice. Instead, all information, content, and materials available are for general information purposes only. Information provided by Sakline may not constitute the most up-to-date legal or other information. Listeners should contact their attorney to obtain advice with respect to any particular legal matter and should refrain from acting on the basis of this information without first seeking legal advice from counsel in the relevant jurisdiction. Only your individual attorney can provide assurances that the information contained herein and your interpretation of it is applicable or appropriate to your particular situation.